You have been told that the US major banks are strong and that the banks are in a much better financial position than in 2008, but that's a complete lie. Nothing has been fixed since 2008. All that has been done is the Federal Reserve has thrown money over it. They've just put paper over the problem to cover it up, but the problems, the fundamental issues are still there. But since 2008, we've actually had two more financial crises because the system hasn't been fixed. We had one in 2019, the repo crisis, and then obviously we had the 2020 money market meltdown crisis and the pandemic in March 2020. Over the past couple months, I've been doing deep research to find out how strong are the banks really, what's under the hood of the bank's balance sheets, and what I found was alarming. In this video, I want to go over my findings from my deep research to show you the huge amounts of toxic debt and derivatives the banks are holding on their balance sheets and the derivatives that the banks are betting on and that are gambling your life savings away. Okay, let's get into it. Now, first things first, in order for us to predict the next financial crisis or what's going to lead to the next financial crisis, you have to learn from history, because the best way to predict the future is to learn from the past. And if the same things that are happening that caused the last financial crisis are happening today, and that's what caused the financial crisis then, you better believe that the same thing's going to happen in the future. Okay, so let's travel back in time to September 17th, 2019, when the actual crisis of what happened in 2020 actually started then in 2019 with the repo crisis. Now, for all of those in the financial world, you'll know all about this. But what you may not know is the issues in 2019 never got fixed. So what caused the repo crisis? And for those, just a quick recap of what the repo market is that don't know, it's an overnight lending market for the banks and all the big institutions where they swap securities like government bonds, corporate bonds, any kind of security in order for cash, and then they pay interest on an overnight loan. Then there's also further repos like monthly, 2 weekly, 3 monthly repos, but it's mostly used for overnight lending for banks. But something happened on September 17th, 2019, and really it was a perfect storm. What happened is there was a huge amount of demand for cash because banks had their corporate taxes were due, but there was an also huge amount of new government bonds that were flooded into the market. But this also happened at the same time in 2019 when the Federal Reserve started tapering its QE and started selling off its balance sheet, because the Federal Reserve balance sheet is held by a lot of these securities that people in the repo market sell and they also buy. And this caused the overnight repo rate to skyrocket from 2% to 10%. And it also caused the federal funds rate, the rate that the Federal Reserve sets for interest rates for the whole economy, actually went above the 2.25% federal funds rate to 2.3% when the Federal Reserve was planning to actually drop it to 2%. And what made the issues even worse is this was also at a time when banks were trying to increase their capital reserves. The Federal Reserve was doing stress tests on the banks and they wanted them to hold more capital and more reserves. So a lot of the big banks like JP Morgan, they couldn't pump liquidity into the repo markets even if they wanted to, because they had to hold those capital requirements. And now this leads to the big four banks having huge amount of power and influence over the repo markets. And if they stop their lending, every time they stop, the Federal Reserve has to come in, and they're the lender of last resort, and they have to come in and buy up everything. So what did the Federal Reserve do on this panic of September 17th, 2019 that many of the new retail investors and many of the people that are new to the financial system may not know about? Well, what the Federal Reserve had to do was step in with, at the time, was a huge amount of liquidity. They pumped in $100 billion in overnight repo liquidity by buying up all these securities, bonds that the banks couldn't sell. And funny enough, this was the Federal Reserve actually buying securities, but they were saying it's not QE, when we all know it's QE. And after that, many people just forgot. They thought, oh, okay, it's fixed. And funny, the Federal Reserve says, look, we're just temporarily intervening into this market. There's nothing to see here. There's no issues here. This was just a short-time liquidity crunch. So we're just going to give a few $1 billion here and then we'll stop. But guess what, people? The Fed never stopped. And you know why? Because the financial system, you can think of it as a ship with a few cracks of it in the ocean. And the cracks are slowly filling up with water and the ship is slowly sinking. But more and more water starts to come in. And so they have to get a bigger and bigger bucket to get the water out of the ship to stop the ship from sinking. Well, this is what's happening in the financial system. There's cracks. There's huge liquidity problems in the markets. And so the Fed will pump in $100 billion to try to stop the sink from shipping. But then more water comes in. Okay, there's a more liquidity crisis happens. So then they have to pump more and more money into the system to keep it afloat. But we all know what happens with a ship that has cracks with it in the middle of the ocean. Eventually it sinks, and I'll get into why. So now that leads us to the panic of March 2020, when the financial system broke again. And if you watch the Federal Reserve Jerome Powell's interview with 60 Minutes, he even admitted that not only in 2008 the money markets completely dried up, that means everyone did run on all the securities, people, all the fixed incomes, all the mutual funds that have fixed incomes like corporate bonds, corporate debt, US government treasuries, all the markets completely dried up and they failed, and the Federal Reserve had to step in again and bail it out. And even Warren Buffett, if you look at his latest Berkshire Hathaway annual meeting on Yahoo Finance, it's about 5 hours. And what they normally do is they normally do highlights from the meetings, but they didn't include this highlight. About an hour and 47 minutes into the meeting, Warren Buffett was asked why did he sell a lot of the bank stocks and why didn't he buy a lot of stocks in March when they were on discount, 40% down. And actually in 2020, Warren Buffett and Berkshire Hathaway were net sellers of stocks. Well, he says because the money markets broke. So he says what Jerome Powell says, and most people don't know that the financial system completely froze up in 2020. So he was terrified. He didn't want to go and risk his company by buying up this toxic debt, because he didn't know that the Federal Reserve was going to go up there and do things unprecedented like buying corporate bonds. So he didn't want to get in the market and touch anything. And what actually happened in March 2020 that was worse in 2008 is there was a complete liquidity crisis in what is known to be the most safest asset class in the world. Normally when there's fear in the markets and panic in the markets, people, they take out all their money from all other assets and securities and they put them in the 10-year or 30-year US Treasury bonds, which is known as the safest asset class. But even that got dried up. No one was buying US government treasuries. They were all rushing for the exits and for cold hard cash. There was huge amounts of panic in the markets, and what took years in 2008 just took weeks in 2020. And so on March 15th, the Federal Reserve came out and they had to do something unprecedented and something big to stop the panic. And on March 15th, the Federal Reserve announced it was going to buy $500 billion of US treasuries because no one else was buying them. So they had to step up and buy up everything. And they also announced they would buy $200 billion of mortgage-backed securities. This is buying like they've never bought before, because like I said, more and more water sinks into the ship, so they have to get bigger and bigger buckets to get the water out. AK, with the financial system, the more QE they do, the more money printing they do, the more and more money it takes to stop the ship from sinking. But guess what? That wasn't enough. The stock market continued to plummet. The money markets continued to dry up. And so the Federal Reserve had to do something completely crazy, even crazier than this $500 billion of buying government bonds and $200 billion of mortgage-backed securities. They announced QE infinity. That's right, QE infinity. And people cheered. They roared. They said, yes, QE infinity. The Federal Reserve is coming to save the day. But little do they know, this will also be their demise. Think for a second. Unlimited money printing, infinity. So if they can create an infinite supply of something, then that means that product that has an infinite supply is worthless. So that was the day the dollar started to die. Now, it hasn't died yet, but it will eventually die, because in the next financial crisis, they're going to have to print so much money, they're going to have to announce trillions or hundreds of trillions of dollars of QE. At that point, people are like, yo, I'm out. This is doomed. This dollar, this is worthless. But the general public are starting to wake up to this, but they're not fully awake. There isn't enough knowledge out there. So keep sharing these videos to let people know. But let's keep going. And so again, going back to the repo markets, like I said, in 2019, they injected $100 billion in overnight repos and about $20 billion. And they just kept on injecting billions and billions of dollars in the repo markets from September 2019 all the way to March 2020. They never stopped, remember, but then the repo markets failed again in 2020. So in 2020, the Federal Reserve announced it was going to increase its overnight repos to $1 trillion. That's right, $1 trillion in overnight liquidity. Can't you see how every time they print money, the next crisis, they have to 10x what they did the last financial crisis? Not only did they provide $1 trillion in overnight repo market liquidity, they also announced they're going to be buying $500 billion worth of 1 month repos and $500 billion of 3 month repos. news. And on March 18th, 2020, they announced they're going to increase the limit per borrower. So again, this is just recent. This was only a month and a half ago. In March 2021, when they said, everything's fine, everything's fixed, they announced they're going to increase the limit per borrower from $30 billion a day to $80 billion a day. So if everything's fixed, if everything's all hunky-dory, why are they almost tripling the limit? Because remember, Jerome Powell keeps going up on his pedestal and saying, the banks are strong, everything's fine, nothing to see here. And then things got so bad, they decided to do something unprecedented, something they'd never done before. And on April 9th, the Federal Reserve announced it was going to backstop $750 billion of corporate bonds. So that means the Federal Reserve started buying up all this corporate debt, like Amazon, Facebook, Google. They were buying their debt. How crazy is that? And guess what? They used taxpayers' money to do it. They got $75 billion from the US Treasury, and then they leveraged that 10 to 1 and increased that to $750 billion. And not only did they start buying mortgage-backed securities for residential, they also started buying commercial mortgage-backed securities because the commercial real estate market looked like it was going to completely collapse with people exiting the cities. So people, are you starting to get the picture here? The Federal Reserve is buying up everything in existence, every toxic debt and derivative you can think of, the Fed is buying because the financial system is completely broken. And it wasn't just US treasuries that it had to buy, it was also state government bonds it had to buy because the state governments needed money and there was no one buying state government bonds, so the Federal Reserve had to bail out the state government bond market too. And so how did the Federal Reserve do all this? Because they're not allowed to buy corporate US bonds, and they're not allowed to do all this crazy QE by buying all these toxic derivatives. But what you have to know, in the Federal Reserve Act of 1913, there's actually a part, section 13(3), where all the Federal Reserve has to do is just go to Congress to get permission to increase their powers, and then they can pretty much buy anything. If they can, as long as they can get permission from Congress, they can buy anything they want. So what do you think the Federal Reserve is going to do during the next financial crisis? Are they going to buy stocks directly, ETFs, or could they even start buying your homes and you own nothing? And you want to know something even more crazy? Not only did the Federal Reserve bail out the whole US, it bailed out the entire world in 2020. Because you know why? The Federal Reserve and the US hold the world reserve currency status. But with that status, it comes great responsibility. And the Federal Reserve actually has international swap lines with 5 other central banks, with the Bank of England, with the Bank of Japan, with the Bank of Switzerland, with the European Bank, and the Central Bank of Canada. So all these central banks needed US dollars. So then the Federal Reserve had to go out there and do swap lines where they gave these other central banks US dollars in order for them swapping and buying US treasuries. But they already had 5 permanent swap lines with these central banks. But guess what? They increased these swap lines to many other major central banks around the world. And just look at the Federal Reserve's balance sheet, people. It's increased from below $4 trillion to $8 trillion. It's pretty much doubled in 1 year. Do you think everything's strong and everything's great if the Federal Reserve is having to do this? And we already know that the M1 and M2 money supply has gone completely insane in 2020. And of course, so now they're having to manipulate the data because people are waking up to the huge amounts of money printing they're doing. Even you got TikTokers talking about the money printer go burr. Okay, so now that we know what caused the 2019 financial crisis and what led to the 2020 financial crisis, even though the 2020 was caused by a pandemic, but still the money markets are broken, and that's what caused the stock market to go plummeting. How can we use this information to predict the future, and how strong are the banks today, and how much toxic debt and derivatives do the banks hold today compared to 2008? Let's have a look. Now let me give you an analogy here. Say for example, there was a gambler that went to a casino and he had $1,000. And he's like, you know what, if I double my money here, I'll make $2,000. This is awesome. But imagine the casino says, hey, you've got $1,000. What if we actually lent you and let you gamble with $150,000? That way, if you double your money, you'll actually make $300,000. Sounds great, right? And of course, the gambler, he's a gambler. He's going to be like, yes, give me all the money you want, $300,000, I'm going to be rich. But if he loses that $150,000, he now owes the casino $150,000 instead of just losing his $1,000. Well, have a look at this, everyone. Look how much derivatives Goldman Sachs is holding compared to their assets. They have $271 trillion in assets, but guess how much derivatives they have? $42 trillion in derivatives. That's a ratio of 154 to 1. Completely insane. And if Goldman Sachs derivatives go down, the whole financial system is going to go down. But it's not just Goldman Sachs that has huge amounts of leverage. Look at Citibank. It's got $1.6 trillion in assets, but it's got $40 trillion in derivatives. That's a leverage of 25 to 1. JP Morgan has $3 trillion in assets, but it's got $47 trillion in derivatives. That's 15 to 1. And Bank of America, they're one of the lowest ratioed banks. So I guess that's why Warren Buffett sold all those other banks and he's still holding Bank of America, because they have a lot less leverage than the other major 3 US banks. They've got $2.2 trillion of assets and just in loose terms, $14 trillion in derivatives. And you can see Wells Fargo here, they've got $1.7 trillion in assets and $8 trillion in derivatives with a ratio of 4 to 1. And if you're wanting the source of this information, this came from the Office of the Comptroller of Currency, Washington, D.C. This report was released on March 2021. So this isn't just speculation here. You can go and read the report yourself and get all the facts. And look at this report, guys. In Q4 of 2020, the total amount of derivatives that's held by the US banks, that's right, just in the US, is $163 trillion in toxic derivatives. So for all those that don't know what a derivative, it's pretty much just a financial agreement to bet on what an asset is going to do. Say, for example, I think a stock is going to go from $100 and in 6 months it's going to be $200. Well, I can enter in a contract, like for example, forwards or options, and I can enter into a contract with another party and say, I bet that this stock is going to go to this price. And so if I win, I make more money, and if I lose more money. And there's pretty much derivatives, and there's pretty much just bets on any kind of financial instrument that you can think of. So as we can see here in this report, interest rate derivatives are the biggest one with 116 trillion. Foreign exchange FX is 39 trillion. Equities have 3.7 trillion, commodities 1.3 trillion, and credit derivatives are $3 trillion. And guess what? The major big 4 US banks own 88% of all derivatives out of the 4,000 odd US banks. Now, one of the biggest derivatives is something called credit default swaps. And for those that don't know what credit default swaps are, it's pretty much like swapping the credit or default risk from one party to another. Say, for example, if a bank issues a home loan to a customer, but the bank wants to buy insurance in case that customer defaults on their mortgage, it will buy a credit default swap from, say, for example, another bank or big hedge fund institution insurer from lender B in case of the scenario where the borrower defaults on that home loan. But what happens in this scenario where not only the borrower that took out that home loan defaults, but also the insurer defaults? That's what caused the 2008 financial crisis. And also something crazy that happened this year that was big news and then it kind of just died and went away was the big Archegos incident, where one person, one family office, one tiny hedge fund that had $10 billion in assets, they went to all the big US major banks and they leveraged their assets using these toxic derivatives 10 to 1. They increased that $10 billion to $100 billion of exposure. And of course, when they defaulted, this caused shivers to go down Wall Street's spine. And this is why I think the stock market is slightly falling now, is because all the banks are calling up their clients to make sure they haven't cross-collateralized and to make sure they haven't over-leveraged, and there's a deleveraging going on right now. And so why do the banks use these toxic derivatives? It actually allows the banks to avoid the Volcker rule that bans them from owning a hedge fund, but it gives them exposure by lending to the hedge funds directly while still letting them loan out their balance sheet to a hedge fund, and it allows them to ignore the Federal Reserve Regulation T, which put limits on an initial margin loan of no more than 50% of a purchase price of a stock, and it also allows them to ignore their own international broker-dealer rules on loaning against concentrated stock positions. Okay, so now that we know that the banks have a lot of these toxic debt and derivatives and there's huge amounts of leverage in the financial system, what is actually going to be the pin that pops the bubble, or what's going to be the domino effect that sends markets tumbling? First thing is greed and speculation. What you need to know what caused the 2008 financial crisis is because there was an insurer called AIG that was selling these credit default swaps to banks. But what actually happened is they weren't hedging their positions. They weren't buying insurance for insurance. So when all these customers defaulted and the banks went to the insurer, they went to execute these credit default swaps, the insurer didn't actually have the cash and the insurer was insolvent. But what caused AIG to do this? It was greed. They wanted to collect the premiums from selling these credit default swaps and they didn't want to hedge their positions. So if we get another big hedge fund institution or another bank that gets greedy and that wants to do this, like what Goldman Sachs is doing with 154 leverage to 1 from its assets to derivatives ratio, if all of a sudden people go to cash in these derivatives, they're not going to have the money there and they're going to default. Also, incompetence. These financial products are very, very complicated. And even I'm still learning about these crazy derivatives because they're very complicated. So if they make any mistakes with these derivatives, it could cause a domino effect and it could cause the financial system to completely melt down. Now that leads us to our final risk, counterparty risk. What you have to know with these derivatives, it's like a domino effect. When one fund falls, it's a domino effect. So even if the big four banks aren't at risk, if there's another international bank or another international hedge fund or any other smaller hedge fund has a huge default, it's going to send ripple effects throughout the whole financial system. And something that's crazy, what we have to know is these toxic derivatives are being held by federally insured banks. So that means if they go bust, the taxpayers, you are going to have to bail them out. So they've got the upside risk of they can make huge amounts of money by betting your life savings away on these toxic derivatives. And they've actually got no downside because if they fail, of course, the Federal Reserve is going to come and bail them out and the taxpayer is going to come and bail them out. But where is the outrage, everyone? This is why I'm so passionate about this topic, because Wall Street is screwing you. They're screwing you hard. Pretty much all investors today, all retail investors, they've got something called Stockholm Syndrome. The hedge funds are abusing the retail investors, but they're cheering them on saying, yeah, keep on doing these toxic derivatives. They're going, yeah, they're cheering on the Federal Reserve with all its QE. Meanwhile, the dollars are being devalued heavily. Meanwhile, insiders are now selling at the top of the stock market while retail investors continue to pile in. And meanwhile, the cost of living is becoming more and more burdensome. Housing is going up out of control. The rich are getting richer and the big hedge funds institutions are going to own everything and you will own nothing. Okay, so now that we know we're pretty much screwed, what can we do about it? What I've been harping on about is it's time to invest in real hard assets like commodities, not financial advice. This is just what I'm doing to prepare. We all know the stock market over the past few weeks has been a bit, it's been like a ping pong match. It's been going back and forth. One day it's up, one day it's down. One day it's up, one day it's down. But we do know that the hedge funds, the insiders are selling, and it's the retail investors always that get hurt at the top. They come and buy, the dumb money buys at the top, and the smart money selling. But commodities still are performing well, and some of them are lower than what they were in the 80s and 90s. Because what's happened is in the 80s and 90s there was high inflation, so then commodities skyrocketed. But we haven't had official high inflation for a long time. But now we are starting getting expectations of high inflation, so commodities are going to perform well. Now, precious metals should be performing well, but they're being heavily manipulated. And I'll show you a chart that shows you what the banks are doing with the precious metals market. So look at this chart. This was also released in this report. This is the amounts of precious metal contracts by maturity. So this is the amount of derivatives that the banks are buying for precious metals to manipulate the markets. As you can see here, in 2001, there was barely any. But now it is absolutely skyrocketing the amount of derivatives the banks are holding or buying for precious metals to manipulate the prices. This is proof here. We all know that they've been doing it, but not many people have been showing the data. But this is the real data that shows you what they're doing with the precious metals market. But you always do want some insurance and to hold some hard, not paper, precious metals in case of a complete financial collapse. Also, this is a bit of speculation here, but I do like Bitcoin because it's decentralized, because it's away from Wall Street. It's not always correlated with what happens to the stock market. It is a bit correlated with the retail investors' tech stocks, but that's just also a hedge against inflation. It's a hedge against the dollar being devalued. And what many retailers don't do is they just hold their Bitcoin on exchanges, but you can actually hold your Bitcoin in a hard wallet. You can have your own private key that no one knows but you. So even if the government tries to confiscate it, as long as you don't give them your phrase, they can't get it. But something most people don't talk about is the cost of everything is skyrocketing. So you're going to want to buy things before the prices go up, because when hyperinflation hits, the price of bread can go from $1 to $10 the next day. Now, obviously, you can't store bread, but you may want to start looking at long life food or long durable foods. And those durable foods, if you've been a prepper and you've been prepping for a long time, these durable good foods that store value for years and years, they've actually been outperforming the S&P 500. And for all those that think there's really going to be full-on crisis and financial collapse, you may want to start becoming a prepper, like growing your own food. So that way you don't have to rely on, if there's hyperinflation, you've got your own food source. Also, if energy prices skyrocket, you want your own energy resource, you want your own warmth resource, and you want your own shelter. So these are just a few ways you can prepare for what's going to be coming eventually. Now, I can't predict the exact time, and nobody can. Not even the biggest and brightest economists and banks in the world can predict what's going to come. But we can get a rough idea of where we are in the cycle. And right now, we're in euphoria. If you even mention that the stock market or the financial markets are in a bubble, that there's a risk of collapse, people will come out there and want to crucify you. And that's how you know we're getting close to the top, when there's huge amounts of FOMO, and when you're hearing people investing in things like Dogecoin and becoming millionaires. People become blinded. They want to believe it so much that they can turn their $1,000 or $10,000 into $1 million, that they will ignore the facts because there's so much emotions involved in investing. So everyone, that's just my research and findings on what's happening in the financial system right now. I hope this was educational and informative, because again, I don't want to be all doom and gloom. I think doom and gloom is saying the stock market's going to fall, the sky's falling, without providing any facts and figures on exactly why it's going to happen. So this isn't doom and gloom, this is facts, people. But people in euphoria, in the top of the bubble, nobody wants to hear the facts. And for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you up to date with the latest that's happening in the stock market, housing market, and global finance news. If you're bored, I'll put up some other videos here. I'll see you there.